This is Mark Sobel, U.S. Chair OMFIF. Today, I'm delighted to be joined by Randal Quarles, former Vice Governor of the Federal Reserve Bank Board for Supervision from 2017 to 21 and Chair of the Financial Stability Board. While many think about Randy in terms of bank supervision and regulation, like all former and current Fed governors, he's a monetary guru, whether he likes it or not. And we're going to discuss yesterday's FOMC and the monetary and financial stability outlook. On a personal note, I'd say that Randy was also a former U.S. Treasury Undersecretary for Domestic Finance and Assistant Secretary for International Affairs in the early and middle years of the George W. Bush administration, when he had to put up with me. And I would really like to say that Randy was one of my favorite all-time bosses. He was extraordinarily smart, thoughtful, friendly, respectful, and while his philosophical leanings guide him, he always listened carefully and eagerly to all points of views and pragmatically and technically weighed them in his deliberations. So whether you agreed with where he came out or not, he embodied the values of the ideal policymaker. So welcome, Randy.
Thank you. Good to be here.
Okay, well, the first obvious question is your general take on yesterday's outcome and what stood out, if anything, in the statement, press conference, or dot plot.
I guess I'd say that I think that the main takes that I have, I think the market perception or public. Well, I think the press conference was more dovish than I think the data justify, or maybe that's unfair. Certainly, but I don't believe it was as dovish as the markets have taken it to be. The Fed's at an inflection point that we all knew was going to come. There was reason to believe at the outset of all of this that interest rates wouldn't have to rise as high as sort of traditional rules would have suggested. The Taylor rule, for example, at the outset of this would have suggested you needed to raise short-term interest rates to 9 or 10%. There was reason to think that that wouldn't happen. Even John Taylor thought that that wouldn't be necessary because of the long period of time that the financial system and the economy had accustomed itself to such low levels of interest rates. You were increasing the cost of short-term debt service by such a huge percentage with any nominal or absolute increase in the interest rate that you would expect that to have a bigger effect. That was a reasonable hypothesis at the outset of this, and it was a reasonable hypothesis at the outset of this that you wouldn't have to keep interest rates at an elevated level for as long as history would have suggested you had to in order to constrain an inflation of this degree, principally because of the revolution in central bank communications that has happened over the course of the last, since Bernanke and Mervyn King, say. And the idea era of Greenspan, who famously said, if you think you understand what I'm saying, you obviously have not been listening, or words to that effect. So both of those were reasonable to believe, but it was always clear at the outset of this that however high you had to raise interest rates, they had to go much higher, and however long you had to keep them at that level, it would have to be some period. And so you could have unanimity on Fed policy for some extended period until you got to the inflection point. We're now at a point where inflation has, in fact, come down with interest rates much lower than the Taylor rule would initially have suggested they needed to be. And but it hasn't made it down to the target. And it has taken, it hasn't taken as long as, say, the Volcker policy took to work its way through the system, which is the last time we had an inflation that was sort of this significant. But it has, it has come down over a shorter period of time than that took. But it's not down to target. So now you have a decision as to, well, is it working, and we're going to get to target very, relatively quickly. Do interest rates need to go higher? Is that the reason we're not at target? Do interest rates just need to stay at this level for longer? And is that the reason that we're not at target? And the committee is going to have a lot of different views about that. And that's going to, I think, muddy the clarity of communication. And people are going to and increase the risk that people overinterpret and misinterpret statements of various participants, including the chairman, particularly over this next period. I do think that people have either overinterpreted or misinterpreted some of the things that Jay said yesterday. It's kind of been taken as saying, well, we're headed towards interest rate cuts, and we're not going to let the continuing tightness in the labor market or the fact that the road down has been bumpy, or that we've reached some plateau here, delay us. But what he actually said, what I thought was the most important thing, was we're not going to let that be the only consideration, but we're not going to under-consider those facts either. I think it really just depends on what happens to their inflation target over the course of the next period, 6 months. And if it doesn't come down further, and if the labor market measures don't sort of resolve themselves better over that period, which is possible, but which I doubt, then I don't think you'll have a majority on the committee to take interest rates down, certainly at the level that markets are expecting.
Well, that's great. We can dig into that. You've given us good fodder. So let's find out about your views on the price outlook and the labor market situation. So on inflation, a lot of noise, goods prices down, services holding up. Everybody says housing coming down, but it isn't so far. How do you and wage growth doesn't necessarily seem compatible with 2% inflation target as of now, according to many. So when you put it all together, what's your take on the last mile and getting back to 2% and timing for that?
Yeah, I think that sort of to go back to the way at least I framed the question at the outset of the two hypotheses, interest rates wouldn't have to go as high, they wouldn't have to stay for as long, high for as long. I accepted both of those. I thought both of those were reasonable at the outset, and that a 5% interest rate over a period of less than a year would be enough to constrain the inflation that we were on. I think the first of those hypotheses has been shown to be correct, and the second has been shown to be wrong. And when you look at the sort of it probably should have been obvious. I certainly see some folks on the screen who would have said this was obvious at the outset. And maybe, maybe in peacetime, that hypothesis that with the revolution in central bank communications and the greater sort of specificity and clarity and frequency, and that during sort of normal monetary policy moves, you could expect that to be true, that understanding the path of central bank policy is going to speed the getting to the end point of any particular normal move. But in an exceptional case like this, where you have kind of increased the cost of short-term debt by 20 or 22 times over the course of a year, anticipating or moving ahead of the Fed is going to cause such pain, particularly for financial players, that you're going to avoid that refinancing for as long as possible. It could mean bankruptcy. Certainly, it means a great deal of stress. And so it's going to take a long time for a particularly intense move, such as the Federal Reserve has made over the last period, for for that to work its way through the economy. People will avoid accepting those interest rates to the extent that their contractual arrangements allow them to for as long as possible. I think we're running to the end of that. We'll start to, everyone here is familiar with the various analyses that have been done about kind of the refinancing schedule of various highly leveraged entities, particularly in the financial system over the course of the summer. And I think you'll start to see that, but I think it's going to take a longer period of time. Obviously, it already has taken a longer period of time than I thought would be necessary at the outset, and I think it's going to take a longer period of time to contain this inflation. And I think you see it in the data points that you described. That last mile, again, history tells us that last mile is the hardest mile in taking inflation down, and we're there.
I think one of the things that stood out to me in the dot plot was the markup in the growth outlook for this year from 1.4 to 2.1%. Pretty hefty markup. And labor market seems to be hanging in there quite well. Some economists are saying that financial conditions are actually lax. So how do you see kind of the second pillar of the mandate?
What order do you put them in? Which one is the second one?
Sorry. Price stability and maximum employment.
Okay.
I'm on maximum employment now.
You're on maximum employment. Okay.
The two are equal.
There are a lot of people who put them in a different order,
including the Federal Reserve Act.
So maximum employment. So obviously employment is very strong. The data is very strong. Again, at the outset of this, we had employment that was an unemployment number that was as low as this pre-COVID. That was consistent with no inflation in the economy and no real inflationary pressure in the economy. I don't think that there's anything that has fundamentally changed in labor market dynamics over the course of the last couple of years that would suggest that you couldn't have an unemployment rate that is low as this, and have that be consistent with a non-inflationary environment. What has been a big issue is the very high vacancies rate, and therefore putting it, which is both, you see it in the data and you see it in the anecdotal evidence from talking with business people, from investing in various companies around the country, that the shortage of labor is driving wages up, and is continuing to do so. Now, again, as a logical matter, you could imagine a resolution of those pressures entirely through the vacancies rate. So you could have unemployment stay just as low as it is, or somewhat higher, but at historically low levels. But the vacancies rate come way down, and that could relieve the upward pressure on wages, and the vacancies rate is coming down significantly. Now, that's logically possible, and there may be some Earth in the multiverse in which that will happen. But the odds are that living on our Earth, that those pressures will resolve themselves for some movement among all of the unemployment rate and the vacancies rate and the labor force participation rate and the quits rate. And so I think you will, we're definitely seeing, we're seeing progress, but I think you'll have to see materially more progress, and that will happen both through principally the unemployment rate and the vacancies rate in order to resolve those pressures. And we're not there yet.
Okay, so just what's your bottom line? The market seems to have fallen in line with 3. cuts this year, which is what the dot plot is. So what's your outlook for the Fed funds rate path and timing?
I don't expect more than two. Um, uh, in part because I think because I don't think that the data are going to justify more than two. It's conceivable that there could only be one before the end of the year. I think that there are some, ancillary consequences of that as you go over the summer, and it becomes clear that the data aren't going to justify rate cuts at the pace that the market has been expecting, possibly even the schedule. That is to say, you get to June and realize that that's not going to be a cut in June, which I think is certainly a possibility. Then that will lead to a significant amount of disruption in markets that rely on the interest rate as sort of a contract bridge proxy for what's going to happen. I think you'd see a lot of disruption in the sort of volatility in the equity markets in particular over the course of the summer, as it becomes clear that the interest rate path is not going to be as accommodating as people have been expecting.
Thank you. You may have just made some headlines. Great. Well, let me maybe just ask one last question, and then we'll turn over, and I may come back to you at some point with some Basel III questions, since I know how much you love the topic. But this is more financial stability, Silicon Valley Bank, New York Community Bank, lots of concern over commercial real estate lending. Some say the stock markets are too frothy. There's questions about mark-to-market losses on bond portfolios. You've just outlined a scenario which could create further bumpiness. Do you have major financial stability concerns these days?
I don't really have major financial stability concerns. Again, I think there will be volatility in the markets, and I think that we will see, I think we'll see additional pressures in the financial system along the lines that we saw in the spring of last year. That's almost inevitable when you have had whenever you've had a very rapid shift upward in a rapid tightening of monetary policy. There are going to be actors in the financial system that have highly interest rate sensitive assets and highly mobile liabilities, for whom that is a disaster. And again, the last time we had this, it was more intense and the problems were more deeply embedded, and therefore the drama was greater. But the concept is exactly the same as the savings and loan crisis. You had I think it was exactly the same, including the genesis of the inflationary pressures. You had sort of very lax fiscal policy over an extended period of time, led to a very significant inflation. And the savings and loans, which were which were a dramatic example of entities that had highly interest rate sensitive assets and highly mobile liabilities, were never going to survive that. And there was a lot during the resolution of the savings and loan problem. There's a lot of talk about pirates and graft, and there was some. But there's not enough graft in the world to bring down an entire section of the financial system in the way that happened in the 80s. It was a result of those events, and again, to a lesser degree, over a lesser period of time, dealing with less embedded problems. But that's what we have seen in the spring and are continuing to see in the financial sector. With entities that have highly interest rate sensitive assets and highly mobile liabilities coming a cropper. And I think we'll see some more. I expect to see them in the non-bank sector as opposed to the bank sector. We have much less visibility there. A lot of the riskiest activity because of the post-Great Financial Crisis, Basel bank regulatory changes, a lot of the riskiest activities have been moved out of the banking system. They're mediated through the non-bank system now. And I think that's where there's the possibility for the biggest surprise, because we have less sort of public and official sector insight into what's happening in the non-bank sector. But all of that said, I don't expect that to turn into certainly nothing like the sort of financial instability that we saw in 2008 and 9, really even the financial instability that we saw in the late 80s with the savings and loan crisis, which was sort of less systemically consequential, although very important for the savings and loans. There's so much more capital in the system, much of it concentrated in the banks, but that allows the system to as a whole, to be more resilient to the shocks that would reverberate through it from the failure of some more institutions.
Great. I should note, I do think that the interactions between banks and the non-bank sector merit good scrutiny these days. Thank you for those fantastic insights. Greatly valued.